Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a Loonie in any of these financial markets.
Hi everybody, my name is Richard Diaz and this is the IceCap Canadian Market Wrap. Each week on this channel, we're going to explore some macroeconomic and market related themes and how they affect Canadians and Canada. We're going to have some fun. We're going to learn stuff. We're going to make mistakes, but hopefully you'll enjoy this journey as we address and challenge and investigate different subjects that we read about and hear about on the news wire. This is going to be a journey for all of us. I'm going to learn how to best serve you guys. I'm going to give you some insight into how IceCap Asset Management thinks about things and why we think about certain things a certain way, the opportunities and the risks. To be clear, this is not investment advice, but it is an insight into how we view the markets. So with that said, let's get started with episode 1, Canada's Energy Transition Fairytale. So first of all, what is the energy transition? Why do we care? And what does it mean for Canada? These are the 3 questions we're going to seek to answer in our short little video. Obviously, we can't cover every single thing about this topic or these topics, but we're going to try our best to distill sort of the most important points about why we think this is an important subject, and most importantly, why we think it's a fairy tale. So let's get started. What is the energy transition? So the energy transition refers to the global energy sector's shift away from fossil fuels, fossil-based systems, to renewable energy sources like wind and solar. So as you can see from the chart, we're going away from dirty stuff, so smokestacks and ugly scenery and bad air, towards supposedly cleaner air and cleaner methods of energy. Now, it's important to understand where we came from when we're talking about energy transitions. There have been many energy transitions in the past. I mean, you can imagine Neanderthals and Homo sapiens in caves lighting fires with sticks and stones. And then the first commercial oil well, I think, came online in 1859. Then coal really kicked off, and later on to really power the Industrial Revolution. Hydroelectricity, which has been around for a while, but really took off in the 70s, along with nuclear power, and of course, natural gas, etc. So there's been different types of energy transitions, but the important point to note from this chart is, despite all of the sort of the press around renewables, you can see that the vast majority of energy remains fossil fuels. It's about 80 or so %, depending on the day you calculate it. In 1965, it was about 93. So there's definitely been a change. Most of that difference has been gobbled up by hydro and renewables. But we're going to talk about really what the energy transition is. That's the first thing. Second of all, why do we care? And of course, what does it mean for Canada? Why are we obsessed with this energy transition? Really, the motivation, I think everyone should know this by now, is carbon dioxide bad and it equals climate change. This presentation has nothing to do with climate change. I'm not really interested. As an investor, we are sort of agnostic about that subject. It doesn't affect us any more than it should, than whether or not the sun shines tomorrow or, whether the Canadians win the Stanley Cup. What we care about is the impact on politics, economics, of course, the markets, and how as investors we should be positioned. So the motivation to decarbonize is climate change. But it's really important to understand a couple of the realities. Number one, where the carbon dioxide is mostly coming from. And again, coming back to the idea of this energy transition, whether or not it's a realistic outcome in the near term. I mean, according to the National Oceanic and Atmospheric Administration, it's a U.S. government organization, there's no signs of greenhouse gases slowing down. Most of that greenhouse gas over the last, 20 years has been coming from Asia, as the chart shows you. This chart shows annual CO2 emissions in billions of tons, and you can see where the bulk of that growth is coming from. It's coming from China, but it's not just China. It's coming from other developed markets that rely on coal, but we'll get to that later. You can see actually that North America and Europe have actually done a really good job of curbing their carbon emissions. People don't like to say it, but it's because of natural gas, but that's a topic for a different video presentation. There's another argument that says that, it's because we've shifted all of our production away from North America and Europe and into Asia. And I submit to you, if you go to the source of this chart and look up Our World in Data, they'll challenge that little narrative. But that's not the subject of today's presentation. We're going to talk about the reality that fossil fuels are still king. So this chart is a chart from 1965, and it shows the primary energy consumption, where it's from, and over time, the share of it relative to total. And that big red block that we see is fossil fuels. Like I said, it was around 80%. Good guess from me. The rest is new renewables. It's definitely increased. And one of the reasons that fossil fuels are still king is because of time. It takes a long time to transition your entire infrastructure. Think about every gas station, every diesel truck, every tanker on the ocean, every train. It is difficult to replace hundreds of years worth of infrastructure. The other reason why we're going to take a long time to transition away from fossil fuels is choices. One of the most outrageous things that has happened in the last couple of years is the German government, in their infinite wisdom, has decided to shut down 3, actually the number should be 6 because there was 3 more, but just the article highlights the latest 3 perfectly good nuclear power plants. This is an outrage. Again, not the subject of this presentation, but it highlights that choices that governments make can delay or accelerate the transition. Because renewable energy wasn't sufficiently ready for Germany's industry to sort of hand off away from nuclear power, Germany's had to start to burn much more coal. Again, we'll get to why in a minute, but just to highlight, that's one of the reasons. And then applications. The Saudi Aramco, which is the big big oil company out of Saudi Arabia, sort of the national champion or nationally owned company from Saudi Arabia, highlighted that, we should abandon this fantasy of phasing out oil and gas. I think that that's partly true, but I think it's also false. I mean, in the sense that, if we committed to nuclear energy, I think we could do it. His point, I think, is also as a function of the industrial applications that there are, which fossil fuels simply are just a better method of generating, for example, industrial steam, or putting on the tens of thousands of boats when we're transporting almost 80% of global exports and are on the sea, and that they burn marine diesel. And to switch that over to renewables is basically a fantasy at this stage. So it's, time, choices, and different applications that we use fossil fuels for. Another reason fossil fuels are going to be so hard to transition away from is that we've got a lot of poor countries trying to use more and more energy. And in the next slide, we're going to talk about why fossil fuels are so useful in that transition away from being poor to being rich. But, I want to set you up, give you some context. It's this idea that there are no low energy rich countries. So what does that mean? This chart shows you GDP per capita, so the gross domestic product per capita, and the per capita energy consumption. So to the right of this chart, the top right of this chart, you see rich countries consume lots of energies: Qatar, United States, Macau, Ireland, etc. And at the bottom left of this chart, you get a situation where if you're poor, you just burn less, you use less energy. And where I've highlighted is to show you that there are no low energy rich countries. This is really important because of the following: that in order to improve your economy, these emerging markets, these poorer countries are pivoting and exploiting their fossil fuel resources. They want to build industry. You need energy, and the most reliable, available, and convenient form of energy remains to be fossil fuels. People do not want to hear this, but the reality is, it's true. And so, we can have all kinds of wishful thinking. We can have really sort of well-meaning projections and forecasts to go in the future. But we can see from the following chart why these lower middle-income countries are shifting. I mean, the reality is they are shifting towards increased fossil fuels, whereas rich countries, which already have a significant portion of their either infrastructure built out or they've relied on expensive nuclear power plants, or, have made enormous investments into hydroelectric dams, have been able to sort of shift away from fossil fuel consumption. This chart shows terawatt hours, so like an incredible amount of electricity effect is what this is calculating. They've transferred that into fossil fuel consumption, and again you see where the increase in fossil fuel consumption is coming from. China's a big part of it, of course, but you can see India, low and lower middle income countries. Sorry, I had to cut it off a little bit there. And then, of course, Indonesia, which is, when we talk about coal, we're going to talk about Indonesia. And again, you can see what's happening. Why is this happening? Because fossil fuels are cheap. They're concentrated in giant deposits. They're reliable. They can be burned day or night. And they're convenient, meaning that it's a stable and relatively safe product to transport. So what about electric vehicles? There's been a lot of talk about how, as the world pivots away from internal combustion engines towards electric vehicles, we're going to be able to knock off the immense amount of fossil fuel consumption in the form of crude oil, and it's going to happen quickly and painlessly, and everybody's going to be happy. I mean, here's a projection from Wood Mackenzie and Goldman Sachs, and they've highlighted sort of where we are, which is we burn about 100 million barrels of oil per day. So within the fossil fuel umbrella, there's natural gas, there's coal, and crude oil. Within the crude oil piece, you can refine it into different types of products. You got kerosene, you got jet fuel, you got marine diesel, you got bitumen for the roads, and of course you've got gasoline. So a big chunk of this global oil demand is related to gasoline for fuels for cars and motorcycles and trucks, etc. And here what we have is a forecast on, different types of EV, electric vehicle adoption. So we have, slow adoption case, we're by 2040, 15 years from now, we're still going to be burning 115 million barrels of oil. And even at the hyper adoption case, we're still going to be burning more than 100 million barrels of oil per day. So, this leaves aside the adoption, the issues with EV adoption. Now, there are some people who are a little bit more skeptical about EVs, like I am, and there's some people who maybe know better, who are really high on EVs. Nevertheless, you can see what the projection is. The point is that we're going to be burning a lot of oil for a long time, even in a scenario where the EV adoption is extreme. So why do we care? Why do we care that we're going to be burning lots of fossil fuels and crude oil is going to be is super useful, and that even in a world where everyone's driving electric vehicles, we're still burning lots of crude oil? It's because there's a lot of money to be made in this business. And as investors, our job is to dispassionately assess the potential for future cash flows of these different companies, to discount those future cash flows, and to make investments based on reality and not on hope or a prayer. And what's happening is actually a kind of an ironic twist that's a little bit delicious in my world. I find it funny and interesting, is that green energy policy is the gift that keeps on giving. And in the next slide, I'll explain exactly why. But in this slide, I wanted to highlight what's been happening over the last sort of, 6 to 12 months is that oil and gas companies have been able to record record profits. Now, this is under a Democratic sort of anti-oil president, but this is in the U.S., for example. We know in Canada, oil production is actually at an all-time high, despite the rhetoric from our local government. We know in France, we know that French energy companies, Total is actually involved a lot in refining, not just producing crude oil, but they've had record-setting profits. And so in the next slide, I'll explain why. But the reality is that these companies are actually generating an enormous amounts of profit, despite all of the efforts to combat the use of fossil fuels. And this gets a little bit technical, and Keith told me not to talk about this, but I trust you guys, and I feel like if I do a good job explaining it, you'll understand exactly why I think this is what the phenomena has been and why I think it will continue to happen. And again, all under the proviso of why we care. I said that green energy is the gift that keeps on giving for these oil companies. And the reason is free cash flow or free cash flow yield. So up here, I've explained what free cash flow yields. That's a technical term, But, for those who may not understand finance, but who know how to run businesses, whether it's a mom and pop ice cream store, or, you're an accountant, or you run a real estate agency, free cash flow is the operating cash flow. So the income that you have coming in versus or minus the capital expenditures. Now, for oil companies, capital expenditures, so drilling wells, looking for oil, huge capital outflows is really, really important. But all the green energy, not all of it, a lot of the green energy policy has been focused on curtailing or cutting off or throttling the exploration and production of crude oil. What that means is that oil companies across the world have been basically told not to spend capital, not to explore, not to produce more oil, look for more oil. And these two charts really highlight what's going on. On the left-hand side, this is the Canadian oil sands, mostly Canadian oil sands, and you can see the red line in billions of Canadian dollars is the cash flow. That cash flow comes very simply from how much oil you produce, what is the market price of oil, one times the other is, but let's say roughly cash flow. The capital spending is the outlay that you have to do in order to secure the next well, the next sort of big score, let's say, if you're an oil company, and you're always chasing after reserves. Well, green energy policy has basically told these oil companies to stop searching and looking for oil, stop building new wells. This isn't true for every country, but on the whole, it's broadly true. And you can see this gray bar is the capital spending. And this gap that's opening up in this chart, this is an example of the Canadian oil industry, but it's roughly true for European companies and certainly true for American companies. This gap is what we in the industry called free cash flow, or a free cash flow yield. On the right-hand side, you see the distribution of cash by the oil and gas industry. So for years and years and years, these oil companies make a lot of money, sure, but they have to spend a lot of money in order to find the next reserve, build the new well, keep that sort of flywheel turning. When the green energy policy has been enacted, it has been largely focused on supply. And so the oil and gas capital expenditure to search for new reserves, new fields, has been declining in the same. So this is for sort of global companies on the right-hand side. This is for Canada, but you can see the trend is the same. This blue line is as a percentage of your total cash. So, and what have these companies been doing? These companies, because they can't search for oil and gas, they've been buying back shares and paying out huge dividends. And so that's why, as investors, we care about this energy transition myth. So what does it mean for investors? So value investors are sniffing around. Now, Warren Buffett is, of course, the greatest investor probably that's ever existed. And, he's known to be as a value investor despite his huge holding in Apple. But, it's about looking for stocks that are undervalued, whether it's a low PE or a low price to book and a high dividend yield. So these companies are paying big dividends. They're cheap because nobody wants them, despite the fact they make huge earnings. And we can see that one of the top investors globally has been adding to his position, meaning he's been buying more and more of these oil companies. Now, not all oil companies are the same, but you get the idea. So what does this mean for Canada? Canada is a petro state. Canada is, and now people disagree with that. I've had some colleagues who say that Canada is no longer a petro state. Well, I'll just provide you some evidence and then I'll let you decide. And maybe in the comment section, you can let me know what you think. But Canada's total exports as of, I think, 2023 were $760 billion. A third of those exports, about 30%, was energy. Now, this includes, obviously, crude bitumen, so basically tar sands, crude oil, and then all of the refined products, natural gas, etc. Canada's also has 168 billion barrels of oil. That's 10% of global reserves, and they're number 3 on the list of global reserves. Canada, and then, so that's the setup. Huge reserves, huge exports. The second thing is we're actually fourth, on the country that produces the most oil. So despite the rhetoric we hear from Ottawa, Canada's oil production actually keeps going up? This is because oil is super useful. There's a huge demand for this product. Despite a lot of the investments towards renewables, it is very difficult to entirely shift your entire energy infrastructure away from renewables towards oil. Again, this is despite the best efforts of people. Now, this is maybe the second or third key point from all this. Canada uses this massive inflow of profits, and in the next chart I'll explain in a different way how these profits come, to pay for everything else. So this chart is the current account balance. So in simple terms, it's your exports minus your imports. Now, in the current account, you have to include things that are like services. So these include travel or literally accountancy, or, if you're filming a movie somewhere, that would actually that would count as a service, export or import. And what economies can't do is run massive current account deficits without having a huge impact on your economy. If you run a massive current account deficit, eventually it'll force interest rates to go up in order to draw inflows for investors, or your currency might go down because people are worried about the viability of your debts and deficits. Nevertheless, Canada actually has a current account balance that's in balance. Or this dark blue line is 0.6, negative 0.6. That's basically zero if you round down. And what that means is that Canada's current account balance is okay. The reason this is true is twofold. One, the other services and primary, secondary income don't really contribute, yay or nay. But really, this big red contribution and you can see, is a big positive inflow of hard currency towards Canada. And what that means is we sell energy and oil products to pay for a massive amount of imported goods. Now, this is not to say that we don't export lots of valuable goods. Canada, centered in Quebec, has a huge export industry of, aerospace and aeronautical engineering services and products. Fine. But what matters is the aggregate. And the aggregate tells you that without this massive inflow of hard currency, oil is traded in US dollars, and we send 97% of all of our oil to America, our current account balance would be massively negative. And this would have huge implications for our monetary policy, our fiscal policy, inflation, our currency. What this basically allows us to do is it allows us to run an economy without any consideration for poor productivity, bad debts. Those are subjects we're going to discuss in future episodes. Anyway, so that's that piece. The final piece is really just simply the numbers, the math. So as far as governments are concerned, so we can see from these following charts, it's very, the bar charts are basically very straightforward. Royalties in billions that Canada receives, the government of Canada receives. And on the right-hand side, it's corporate income taxes that the government of Canada receives. And now, if you think of Canada running budget deficits of $40-50 billion, well, between the royalties and the taxes, they've paid for it. Got 30 from here and 10 from here, that's 40 billion. In a good year, it might even be more than that. And so this idea that Canada is going to quickly, painlessly transition away from fossil fuels is a fairy tale. It is not going to happen. It may happen one day, but certainly not in the near term. And I think, so for investors, it's really important. I think for Canadians, this is a vital topic of understanding. It's why we chose it as our episode 1 of the IceCap Canadian Market Wrap. And, we really want people to understand sort of where we're coming from, why we think what we think. And, I accept and welcome different challenges to this view. That's it for today. I'm running out of time. I've gone a little over. Thank you very much for listening. Please like, subscribe, and follow for more. We're going to be discussing all kinds of different subjects over the next few months and years, hopefully. And we thank you very much for this, for following. So yeah, that's it for me. I'm over and out, and I'll see you next time.